Hello and welcome. I'm Amor De Libasic, a licensed financial planner with over a decade's worth of experience, and today we're going to deep dive into the world of sole traders. If you're thinking of starting a business as a sole trader, or you're simply curious about what it involves, this video is for you. We'll explore how a sole trader structure works, the liability risks you need to be aware of, how your income is taxed, and even look at some real-world examples to bring these concepts to life. So let's jump in. To start, let's clarify what it means to be a sole trader in Australia. Now, essentially, you're running your business in your personal capacity. This means you are the business. There's no separate legal entity like a company or a trust. Now, registering as a sole trader is quite straightforward. You'll typically need an Australian business number, which you can apply for through the Australian Business Register. If you plan to trade under a name other than your own personal name, for example, Cool Beans Coffee, instead of John Smith, you'll need to register that name with the Australian Securities and Investment Commission. That can be done online or through third-party providers. Now, compared to setting up a company, the registration process for a sole trader is quite fast and low cost, making it an attractive option for many new entrepreneurs. The biggest drawback that we think about being a sole trader is liability. There's no legal separation between you and your business. You're personally responsible for all debts and obligations. If your business faces financial trouble or legal action, your personal assets, such as your home or property, could be at risk. Now let's imagine, for instance, that you run a small landscaping service and one of your clients sues you over damage to their property. If you're uninsured or lose the case, you could be required to cover costs out of your own pocket, potentially putting your personal savings on the line. That's why many sole traders, one, purchase insurance, for example, public liability insurance to help them against unexpected claims. This is something you definitely want to consider if your business involves taking on client sites, clients, or interacting with the public, or providing advice that could lead to claims of negligence. Now, let's talk about tax. In Australia, any money you make as a sole trader is treated as part of your personal income and taxed at your marginal tax rate. That means if you already have a job and earn a salary, your sole trader income will be added on top of that salary when determining which tax bracket you fall into. Australia uses a progressive tax system, so the more you earn, the higher your marginal tax rate can be. If your business is successful and your profits grow quickly, you might find yourself pushed into a higher tax bracket. On the other hand, if you don't make that much in your first year, or your expenses exceed your income, you might be able to offset those business losses against other forms of income. For example, if you made a $5,000 loss in your first year of sole trading and you have a salary of $55,000, that loss could potentially reduce your taxable income to $50,000. That deduction applies assuming it meets the non-commercial loss rules as set out by the ATO. To meet these rules, you generally need to pass at least one of the four following tests. The first is the assessable income test. Your business activity has to bring in at least $20,000 of assessable income in the financial year. 2, the profits test. The business activity has made profit in 3 of the past 5 years, including the current year. 3, the real property test. You use real property in your business activity that's valued at $500,000 or more on a continuing basis. 4, the other assets test. You use certain other assets in your business activity, such as machinery, equipment, or trading stock, valued at more than $100,000 or more on a continuing basis. Now let's bring these concepts to life with a real-world Australian example. Suppose Emily, living in Melbourne, decides to start a home-based bakery as a sole trader. She applies for an ABN and registers the business name Emily's Sweet Treats with ASIC. She takes out a business loan to buy an industrial oven and some initial stock of flour, sugar, and other essentials. In her first year, Emily's sales are steady and over $20,000, but her startup costs are quite high and she ends up with a loss of $4,000. Because she also works part-time as a bookkeeper and earns $70,000, she can offset her business loss against her salary assuming she meets the ATO rules as a genuine business. This means that she might be able to reduce her overall taxable income from $70,000 to $66,000, lowering her tax bill in that first year. However, if Emily were to face any legal issues, say a customer falls ill and decides to sue, her personal assets could be at risk if she doesn't carry insurance. Another important aspect of being a sole trader in Australia is goods and services tax. If your business has a turnover of $75,000 or more per financial year, you must register for GST. You must also lodge a business activity statement and remit those GST amounts over to the ATO. If your annual turnover is below $75,000, then registering for GST is optional unless you drive a taxi or rideshare vehicle, in which case you must be registered regardless of your turnover. Another factor to keep in mind is superannuation. Now, if you're a sole trader, you don't have to pay superannuation on your own behalf. Unless you have a separate day job, that means you might not be getting any contributions into your superannuation, and that's quite a pivotal thing to get under control when you're thinking about your long-term financial and retirement plannings. In effect, superannuation provides significant benefits over the long term and so shouldn't be neglected for sole traders, even though it's legally not required. So, is becoming a sole trader right for you? The simplicity, low startup costs, and straightforward registration process make it a popular choice for many Australian small business owners. But you'll need to be comfortable with the personal liability exposure, the possibility of higher marginal tax rates if you're successful, and the responsibility for your own superannuation contributions. You'll also need to keep an eye on meeting the ATO's requirements for record keeping and possibly GST. I hope this deep dive into Australian sole trader structure has helped clarify the pros, cons, and tax implications. If you have any questions or personal experiences to share, don't forget to leave a comment below. Don't forget to like this video and subscribe for more tips on business and financial planning in Australia. I'm Amor De Libasic, and thanks so much for watching. I'll see you in the next video.